Can I invite Ajay and Sagar to join me up here? We have a very interesting session today, and we are demystifying term sheets. That's what I'd like to call it as. I do know that many of us have aspirations to receive term sheets. Many of us here, I hope, have received term sheets. I hope there are an equal number who have converted them into definitive agreements and have been successful in raising capital in the past. And we would be happy as part of our exercise this afternoon to also hear from your viewpoints and perhaps address all your concerns and queries to my brilliant panel here. And brilliant because Ajay, for example, Ajay has been an entrepreneur himself. I've known him a very long time, but of course we are not that old, but still, we've known each other a long time. He's an entrepreneur who started RMSI. Thereafter, he has become an angel investor for quite some time now. And he's probably seen it on both sides of the table in terms of receiving term sheets and providing term sheets. So we will perhaps ask him about what was the change in perspective that happened when he changed sides. Sagar is an entrepreneur, and you've seen term sheets, Sagar? Yeah. He's seen term sheets, so he's going to tell you about term sheets too. What we are going to do is to quickly talk about some of the key terms that we can hope to see in term sheets. I think I'm better off seated amongst both of you rather than standing here. I feel taller than I should feel. So I'm just going to join you guys. Don't think I need this. Thank you. So to begin with, I think the most important point about term sheets. Term sheets, what is a term sheet really? For those of you who've never heard the term, so when I put my engagement letter to a client whom I'm advising raise capital, I use a number of terms which are synonymous with the term sheet. So I say term sheet, memorandum of understanding, letter of intent, intention to invest. These are some of the terms that we use to describe a term sheet, or rather to title a term sheet. The term sheet basically, as I also said, is the intention of an investor. It puts down the intention and the broad principles of the intent to invest in your venture. That's really what a term sheet is. It defines two broad areas I would talk about. One has got to do with the valuation and therefore the amount of equity that you're going to hand out for the consideration or the amount that they're going to invest into your entity. And the other equally important, mind you, equally important aspects are the various terms and conditions. Often as entrepreneurs who may not perhaps be as financially savvy or perhaps who may not be as legally informed, and I can assure you a lot of us are not as legally informed, we end up possibly not appreciating and recognizing and realizing what the terms and conditions in a term sheet, and that's what perhaps where the word term comes to through to, what impact they can have. So many a time I will actually, when we are looking at term sheets received on behalf of our clients, we will actually, I do mention it upfront to them that what matters is not only the valuation or how small an equity amount you are transferring or giving out for the amount of consideration or money or investment you're receiving into your business. It is equally important, and I emphasize equally important, to talk about the terms and conditions. A good term sheet, a good investment proposal is one which keeps it, which I often say is a weighted average of the valuation that they're giving you versus the terms and conditions. Now, I've been repeating the word terms and conditions. What do I mean by the terms and conditions? Some of the key terms and conditions will be obviously the most important, that's part of the valuation terms or the financial terms, which is the amount of equity that you'll be handing out. What goes with the amount of equity that you hand out? Do you give a board position, for example? Will they be able to influence the course of your business into the future? In some instances, that's a good thing. In other instances, it's not such a good thing. Really depends on the situation, depends on the kind of entrepreneur you are. For example, there will be terms and conditions relating to how key critical decisions will be taken in the business. For example, there are some terms which you will need the investors, if they sit on your board, for example, they would typically sit on the board, typically, and I'd be happy to hear from both my panelists once we get to that. If it's more than 10%, it's more than likely that they will want to sit on your board. And if they sit on your board for how many matters relating to your business, which are either strategic or tactical, do you need them to necessarily vote in favor of any proposals that are put up versus, they don't necessarily need to vote. That will define the way you can run your business hereafter. So I'm not going to go into too much detail of each one of each of these, but it's going to be important to hear what both Ajay and Sagar have to say about this. So I've talked about board position, for example, and the implications in terms of the voting right on the board that you will have subsequent to having got an investor. There will be equity enhancement related clauses as well. So under what circumstances are they equity enhancement or reducing their participation depending on how the business pans out. So for example, you have a whole lot of clauses relating to a drag along, a tag along, a right of first refusal, ROFR is a term you might hear. You might have a put option, a call option. I will ask each one of you to probably in one line give an explanation of what each of these could be. I could do the talking, but then I don't think that's the idea in the first instance. There would be clauses relating to exit. So how is the investor, how is going to get an exit from your business? Is he going to have, are you going to give him an exit through an IPO, for example? Are you going to be willing to give him an exit through a strategic sale? That is, can he orchestrate with your or without your consent his exit from the business by getting you to exit, for example? Or is there a fixed return which is not strictly, I mean, legally you're not supposed to be able to do that. This is equity, this is risk capital, but there are often clauses which almost give them a buyback option with a, shouldn't use the term, but in inverted commas, fixed kind of return, and where the company or the promoter buys the stake of the invested partner, for example. But I think what I'm going to now do, Ajay, I haven't obviously talked about all the critical clauses, and what is critical will actually be specific to each of the term sheets for each of you who receive it, for example. So what may be critical for you may not be as critical for Navyuk, for example. But Ajay, can I just move to you and ask you to add some of the other critical areas that you can expect to see in a term sheet, and perhaps decode it and present it more simply and not as daunting terms we hear often.
Thanks, Kalpana. So just backing up a little bit, I think, first of all, the term sheet is actually just the basis of a negotiation between the investor and the entrepreneur. The second thing to remember is that most clauses in a term sheet are not legally binding. There are few clauses that are legally binding, but most of them are not. So a term sheet, like Kalpana talked about, the letter of intent, it's actually an intention to do a deal. Okay, so that's the first thing you should remember, is that the term sheet is an intention, it's the basis of the negotiation, and it kind of lays out the relationship that an investor and the entrepreneur are going to have. So that's the first thing. The second is that term sheets can be simple and they can be complicated. Typically in Silicon Valley, if you actually went and looked at even the US Venture Capital Association's term sheets, they're actually very simple. They have basically maybe 4 or 5 clauses that deal with the most important elements of this negotiation. On the other hand, with most Indian term sheets, and I think for this purpose, we're going to focus on the seed, which is pretty much your first term sheet. So we're not going to talk about series A, B, and C. These get more complicated. We're going to focus, right, Kalpana? That was the agreement that I think, Sagar, you've also seen your first term sheet. So we're going to talk about your kind of angel or your seed series, okay, which is basically your first investment. That's a formal investment, not what you got from your friends and families. So if I were to think about kind of 2 broad, simple areas of thinking about the term sheet, the first relates to the financials, and the second relates to governance and control. Okay, so broadly, when you look at a term sheet, think about, okay, what are the financial terms, and then what are the terms related to governance and control. On the financials, there are actually only three really important things that affect you as an entrepreneur, okay? So I'm, again, just focus on the top three things. The first is kind of, okay, what is the money that I'm going to receive? Okay, so that is explicitly listed as part of your term sheet. What is the amount of money that I as an entrepreneur are going to receive, or I as an investor are going to put into your business? The second piece is what's known as the pre-money valuation. Okay, so that's probably your second most important thing. As important, I would say, because both the money you receive and the pre-money valuation are basically going to determine how much of the company you're going to give up. Okay, so that's called the pre-money or pre. And often you'll hear terms like, 2 million on 12. What it basically means is that the entrepreneur is going to take 2 million rupees, dollars, whatever the currency is, on a 12 million pre-money. So your business, before you took the money, is worth 12 million. Once you've taken the money, you have a post-money valuation, which is very simple. It's the money you receive plus the pre-money. So if I following my example, 2 on 12, your post-money valuation is 14. So that's the first very simple basic thing, is look at what your pre-money valuation is and what's the money you're going to receive. The second thing that often is overlooked is actually your ESOP pool, because that affects the entrepreneur. Okay, so I'm just focusing right now on what are the important things for the entrepreneur, what that's going to have a financial implication on how much of the company you're going to give up. So the second is look at your stock option pool. Often investors will ask for the stock option to be laid out separately, and it'll come out of your pocket, the entrepreneur's pocket. So expect that the ESOP pool, that is a negotiated amount. It could anywhere be from 5 to 20%. That's something you negotiate. But that is often laid out explicitly in the term sheet, saying the entrepreneur or the founding team will lay aside a certain percentage as an employee stock option pool post-dilution. So it comes out of your money. It doesn't come out of the investor's money. And the third thing to think about, and we'll get into that later, I wanted to pass it on to Sagar as well, is actually some of the anti-dilution clauses that can affect you when you raise money in a next round. So just from a financial perspective, it's very simple. The amount of money you're getting, the pre-money valuation that then results in a post-money, and the second was the employee stock option pool, and then the third piece is anti-dilution, which will affect your ownership when you raise a next round, if that round is not higher than the round you raised currently. So, Shahid, maybe you can, Sagar, maybe you can give some examples of the kind of pre-money amount, etc., that you experience.
Just one thing before we go to you, Sagar, just a small thing. I just want to ask, how many of you have received a term sheet? Raise your hands higher. I want to see lots of hands. Okay, and how many of you were worried when you got your term sheets that you didn't understand what it was? Okay, and how many of you are worried when you received the term sheet, which was hopefully soon you'll not be able to understand it? Good, none of them, only one of them. Okay, all right, Sagar, all yours.
Hi, good afternoon. So basically, before talking to that question, I want to just introduce myself a bit so that I create more excitement and more buzz. Basically, I represent a brand called Momo. So me and my friend Binod, we founded Momo around 6.5 years back with an investment of only 30,000. I borrowed that money from my dad. And last March, we closed at a turnover of 20 crores with only plowing back profits, no funding. We had a debt of only 1.5 crores in our books. And then we went for a first round of funding after opening 45 stores, all by our own money. So that was a very good thing. Now coming to the funding part, I want to share, being an entrepreneur, being a startup, I want to share my experience when I received my first term sheet, okay? And I want to be very candid about it. So I got my first term sheet 3 years back, okay? I was very excited. The mail, I opened my mail, opened the attachment. I was even more excited than when I got my first love letter, to be honest, I was really looking forward to it. Ki kya hai, kya hoga, kya valuation hoga, okay? Dreaming of becoming a Domino's someday. I opened the term sheet. I think it had 15 odd points. I went through all the points. It didn't affect me because I didn't understand anything, like ignorance is bliss. It didn't affect me at all. Then I tried doing what every youngster does. I Googled stuff, I Wikipedia'd stuff. And after doing that, I went through the term sheet 5 more times. And I had butterflies in my stomach. I was like, drag along, tag along. Arey yaar, ye angels mere business le lenge. Kya hoga, kya nahi hoga. I'm a total banya at heart. I'm very, very protective about my equity because I've earned it the hard way. I understand the value of money. So I was like, I had a lot of questions in my mind, okay? Luckily and very fortunately, my brother's friend was an investment banker. So I decided to meet him over coffee. The meeting extended from coffee to dinner. He gave me 3 good hours. In those 3 hours, he explained all these 15 terms to me. And after those 3 hours, I felt I was a pro at it. I can explain anyone else. It was so easy. It was all so simple. I mean, investors are giving you money. It's quite obvious that they will, protect their interests. I mean, they have the right to protect their interests, which they're bound to do because they're taking a big risk. Similarly, you're an entrepreneur. You have to protect your interest. So it has to be a win-win for both. And it depends on what stage of your business you are in, to what extent you can negotiate and where you stand. So, clarity of thought was there. Yes, I did have that fear of drag along to an extent. Obviously, it will be there with every entrepreneur. But my mindset was clear. However, at that point of time, 3 years ago, we thought we won't take funding. And I'm happy we did not, because after 3 years, we got funding at 15 times more of the valuation than we would have taken at that point of time. With the same fund again. This is through the Indian Angel Network. So I've had a wonderful journey with them. When I got my term sheet this time, I think the only clause which I could not understand was ESOPs. And I was very nicely explained by Padmaja ma'am what ESOP is and how it works. And to me, although I'm diluting a good pool, so we've made a ESOP pool of 10% from our funding. But I'm more than happy I might do it 20% also, because I have a person like Mr. Sanjeev Bikhchandani backing me who has an ESOP pool of 35% in his company. But imagine, I'm taking funding as an ammunition to grow my business. Now, who's going to grow it? Not me alone, it's the team. Now, to have a good team in place, I need to attract them. I mean, today, if I want someone from Yum or a Jubilant to come and join me, if I pay him even, a package of 1 crore per annum, he won't come. But if I give him ESOPs, he will come. So, I want to use this ESOP pool as an ammunition to attract more people into my venture and take my venture to a different level. So, it's very simple. Either you are like 10% of rupees 100 or 10% of maybe, 1,000 crores. So you look at it that way. You look at the larger pie of the entire picture. So that's how I have looked at into this. And I think, I personally think that, for all people who raise their hands, who did not understand when they got the first term sheet, I think it's very natural. It might sound silly, but, I think if we all could get this mentoring before going for funding, or we could get it in college, because now many startups start from college. I was in 3rd year college when I started my business. So,
Sagar, can I ask you to explain what worried you about the drag along right? What is the drag along right and what worried you about it?
See, the drag along right is a right where, supposing you cannot see, like investors are giving you money because they want an exit. So if someone is putting in 10 crores into my venture, he wants to know that by putting in this 10 crores, where do I take my business? So like if I have a 100 crore valuation now, if I take it to 1,000 crore valuation, his 10 crores become 100 crores, say in 2 years or 3 years. Obviously he wants to make money, everyone wants to make money. So they put this drag along clause to protect their exit clause, because supposing if I'm not able to get in an exit, there might be a strategic sale where someone will want to buy us out completely. And if that happens, although they own 10% stake, and if we cannot give them an exit, they have the right to, sell entire company's 100% stake and get their exit.
So basically, drag along means that the minority investor, who's your investor who's come in, if they're not able to get, if the company, if you are not able to give them an exit, they have the right to drag you along, to take you along in getting an exit. So they may sell the entire 100% of the equity of the company to, say, a strategic player or to a larger private equity investor, for example. So they can drag you along, they can bind you to come along in case you're not able to give them an exit. That is what a drag along is.
Yeah, sure. So there are also certain conditions that often the drag along will be either after a certain period of time. So, it's been after 5 years from the time you've been invested. So, okay, can you hear me now? Yeah. So I think the drag along rights are not immediate. They usually are triggered by something. Either the company hits a certain valuation, so there might be kind of a trigger that defines when the drag along right is to be, it can be executed or enforced by the investor, or it could be time based after a certain amount of time.
Yeah. Would you like to talk about some of the other clauses?
So I think the second, so we talked about some of the key financial terms, right? The simple ones are the pre-money valuation, the amount of money coming into the company, the ESOP pool. Maybe another one that we should talk about because it affects entrepreneurs, and entrepreneurs may not understand this fully, is called the anti-dilutory protections. So basically, you know, the expectation when you're raising a seed round is that you will go on to raise more money over time as your company grows. And what the anti-dilutory clause essentially does is it protects the seed investor. So if I'm the investor in Sagar's company as the first investor, if Sagar decides to raise money in the next round, and if the valuation that Sagar raised money at in the next round is lower than the valuation in which I put the money, I protect myself. And this anti-dilutory provisions can range. There's actually 3 types of anti-dilutory protections, and we won't have the time to go into all of them, but I can just give you very simple things. What's good for you is probably a broad-based weighted average. What's probably bad for you is a full ratchet. Okay, so if you hear the word full ratchet as an entrepreneur, watch out for that. Most reasonable angel term sheets will use what's called a broad-based weighted average. But this is usually, the anti-dilutory provisions are usually in cases where the company is not doing well. And so you're raising more money, but at lower valuations. So if your company is continuing to grow, you don't need to worry so much about anti-dilutory.
So some of the other areas that one would watch out for in the term sheets, for example, and one point I would like to re-emphasize, which I think Ajay you did mention, is that a lot of this is up for negotiations too. So whatever you see in the term sheet, don't fall off the table in fear. Often you need to basically assess in discussion, you need to push back and see which of these clauses you're comfortable with and which of these are completely unacceptable to you and which of these are completely unacceptable to your investor too. So that's a point that I would certainly make. But some of the other clauses that you would say is, for example, and that's got to do with addressing some the anti-dilutive intent as well, is the right of first refusal, for example. So if you're going to, and often referred to as ROFR, what you would do, what they would expect is in case you're raising another round of funding, then the first investor or the existing investors, if there are more than one, will have the right of first refusal at the same valuation, perhaps, that also is a term which is defined, that is being offered to you by investor 2 or investor 3 as the case may be. So they may build in that clause which gives them the option to invest in case you want further investment. It is a matter of debate and negotiation that whether the valuation has to be the same as is being provided by a new investor, or there could be some discount to it. Those kind of options do exist, and they are possible to negotiate sometimes, sometimes not. Would you have some others to add? Come on, Sagar.
Yeah, like I said, the investor, the guy who's taking the risk, so you know, most of the clauses is going to protect their rights, which is quite correct, quite right. There are a couple of things where the entrepreneur can also protect himself, because it's equally important for the entrepreneur to protect himself. So there's this clause called vesting of founder shares. So in our case, you know, we were a mature company. We were already making good amount of profits. So generally, in normal term sheet, it's, you know, it's over a period of 5 years. We negotiated and brought it to 3 years, because suppose something happens to me within the next 1 year, I don't want my family suffering. I've worked hard to build my company to this level. So, you know, I get an upfront 20% and then take 20% more after the 1 year. So, you know, I get 40% within the first year and I'm safe. So that's one clause you can look into. Another one is liq-pref, you know, liquidation preference. So, you know, business is like a lot of risks you take, good times, bad times, and we've seen it all, you know. So today it might be very rosy, tomorrow we might see bad times. So just to protect yourself, you should have a liq-pref cap, you know, where, you know, supposing if something goes wrong, what the investor gets back, and then what comes back to you, supposing the company does go into liquidation, etc. So these are the two things, you know, where the entrepreneur can try and, you know, protect himself. And lastly, I personally believe that, you know, mindsets have to meet. I mean, you have to work with a fund or an angel when your mindsets meet. It took the Indian Angel Network and me just 15 minutes to close that term sheet. That's it, 15 minutes. So mindsets have to meet. And that's it. I mean, we are all here to, no one's here to, you know, really kill you and take your business, and neither are you here to, harm anyone. I mean, if your intent is pure, you're bound to make it big.
Well, all the term sheets and thereafter whatever definitive agreements you sign in terms of the shareholders agreement, the share purchase agreement, for example, they are all to be referred to only if the going goes bad. Otherwise, once they're done, you lock them in the vault, in a fireproof vault for that matter, and thereafter forget about it and hope and work towards everything going well. The only time you will really take these documents out, both the investor as well as yourself, is things aren't going exactly well. So when you're evaluating a term sheet, assessing the term sheet for yourself, you need to think that this will come into play in case things go bad. So that's an important point to keep in mind. But Ajay wants to disagree with me.
So, I mean, I don't think the term sheet is only for things that go bad. I think term sheets are also for exits for the investor, right? So we talked about the investment coming in. Now let's talk about the investor exiting from the business, right? Because the idea for an investor is that they want to make a return on the investment that they put into the entrepreneur in the business. So I actually would disagree with Sagar on the liquidation and participating. So let me first explain what that means, because it often, liquidation sounds like a bad thing. It means that the company is shutting down. Actually, the liquidation event can be defined as a sale of, investor A to investor B. There could be a sale of some company. It could be some sale of the entrepreneur shares to someone else. So the liquidation, it could be going IPO. So the definition of liquidation isn't necessarily a bad definition that the company is shutting down. So what investors have is a provision, and this impacts entrepreneurs. So you must pay attention to this clause, and I'm glad, Sagar, you brought it up, is this idea of liquidation preference. And it's actually two parts. Okay, so the first part is, if the investor states a certain liquidation preference, so it might be 1x or 2x, what they're basically saying is that whenever there is a liquidation event defined, such as, for example, a sale from or fresh capital coming in, which involves sale of the investor shares as part of that, the liquidation preference ensures that the investor gets back a certain multiple of their original investment. So if I had put in, back to my example of 2 on 12, if I put in 2 crores into Sagar's company in my seed round, and there is a sale of the company for, let's say, 20 crore, okay, so 12 became 20, and now Sagar decides that he wants to sell at 20. If I had a liquidation preference of 1x, what that would mean is that I would first take the 2 crores back. Okay, so that's my money back. And then if I have a participation, I will start participating in the remaining. So, now there's the remaining to be shared between us. I will start participating in that as well. So the liquidation preference can often be expressed as something X. It will be left blank in the standard term sheet, and you negotiate that. Liquidation preference is typically a good, fair term sheet would be 1x, which means I first take my money back, and then I start participating in the additional profit. Okay, so in the case of 2 on 12, I take my 2 crores back, and then in the remaining, if I have 20% of the company, the remainder I share 20%, Sagar gets 80%. Okay, because assuming there were just 2 of us, he owns 80%, I own 20%. The participation itself can be in 3 different variations. There can be no participation, there can be participation preferred, or there can be participation with a cap. Again, I don't think we'll have time because we want to get companies, we want to get questions from the floor. But so just pay attention to what the liquidation and the participation is, because that affects your outcome when there is a sale, and it depends on how much money you as an entrepreneur get to keep, how much you have to share with your investor.
So basically, what we are saying is that the investor, he's going to, at the first level, when the 1x means you're protecting the amount you've put in. In Ajay's example, the 2 crores is what goes back out of whatever is being liquidated or whatever value gain one is getting. 2 crores will go back to the investor, and over and above that, in the term sheet, you would have negotiated what more will go to them. On a like-to-like basis, they get it pro rata in terms of an increase in the valuation, for example,
So
but it could be.
Crores, so that 18 crores that's left, I would get 20%,
And
Sagar would get 80% of that 18 crores, because I took out the 2 crores from the 20, so now 18 was left. I now get 20% if I was participating.
Okay, what I really want to do, because I think what we could go on, there are so many aspects of a term sheet, and I think there'll be different levels of appreciation and understanding and concerns each one of you may have. What I'm now going to do is going to ask you questions to address to both of them as well as myself. In terms of some of the key areas of concern you may have around a term sheet, anything you would like demystified or explained. Can we have people raise their hands? I think there was somebody who was trying to make a point on what we had said earlier. That would also, we can probably talk about that. Here's the gentleman there.
Hello, my name is Harish Gupta. I just want to know, this drag along clause, is it legally enforceable?
So what will get legally enforced is actually the shareholders agreement. Okay, so like I said, the term sheet is the basis of the negotiation, and you've kind of set expectations. Then this all gets codified into a much more complicated document, which is the shareholders agreement, and the shareholders agreement has legal ramifications.
In the definitive agreement, in the shareholders agreement, it is binding. It is legally tenable.
One question I have is regarding, you talked about the financial terms. Can you also talk about the terms which affect the control of the business, how it will be run, and who will make the calls? I think that's another important part.
So there are rights, for example, selling a piece of your business, selling some of the assets, appointing key senior resources into your organization, making an investment above a certain amount, going to new geographies. It can vary. It's often negotiated between the two, between the investing party and the investee company. If you are offering more than 26% equity holding in your company, for example, then there are some special resolution rights. Some of these I talked about, these are included. So this is basically key decisions which will impact the, shall we say, the security of the investment the investor has made into you. If they're a minority investor, you want to add to that?
I can elaborate on some of this. So I think I'm glad someone asked the question on governance, right? So the first thing about governance is the board of directors. So that's also a negotiation. And a good practice, again, I would say good practice is typically to have a board that has an equal number of seats that are the investor's seats and the entrepreneur. And then you might have one, because you normally want an odd number to make a decision. You don't want a board that has 4 or 6 or 8 or 2. You typically want a board that has 3 or 5 or 7 people on the board, so that there's no logjam, right? You want to have a definitive. So typically, if you're a 3-member board, what you might do is the entrepreneur takes 1 seat, the investor will take 1 seat, and then you might appoint an independent director that maybe the entrepreneur recommends and the investor is okay with, to have third person. So that's a very important part, is you're constituting your board, because the board basically is responsible for a number of decisions. I think in terms of the investor protections and governance, there are certain, at least in the standard seed term sheets that you'll see, whether it's from Indian Angel Network or others, there are other protective provisions that the investors will put in that have actually nothing to do with the 26%. They will actually be provisions that even if you took if I take 15% as an investor, I will have protective provisions. Typically, they relate to things like selling of shares, raising fresh capital, changing the memorandum and the articles of association. Might even include things like compensation to the founding team. So there's often 8 or 9 things that will be explicitly listed in the term sheet, which the investor will have veto rights, which means that the promoter cannot go and sell their shares without getting approval from the investor. Whatever the percentage might be, it will be put in that term sheet. So the 26% is not necessarily true. The investor might have 15%, but have certain veto rights that in a normal company, 26% would have.
No, what I was saying was that at 26%, there'll be some minimum rights which you will have to give your investor. Below 26%, it is a matter of negotiation. And the constitution of the board is often negotiated in sync with the level of dilution. So if you're giving a 10% stake, it has one implication. I did mention it that you offer a board position often at a minimum of 10%, but not necessarily so. It is a matter of negotiation again between the two parties. Would you like to share, Sagar, any thoughts on this?
I guess we've covered most of the points. I mean, if we go on with the points, there are many of them. I personally believe that, I stick to my belief that, I think angels will not do something which is out of the practice, and neither you as an entrepreneur should ask for something which is out of the practice. So I think it's very simple. I think we have our questions. We should come back with our questions, but the closure should not take more than 1 or 2 meetings.
More questions? The gentleman there in the... Yeah, sure. Would somebody get a mic? Yeah.
See, in case of a strategic buyout and somebody wants to cleanse in the shareholding, should there be an explicit mentioning of an IRR in the shareholder agreement?
Sorry, I can't hear you.
In case of a cleansing of the investors, basically say 100 investors in the startup, and somebody wants to buy them out, and there's an exit option for each investor, wherein a sort of an internal rate of return is usually mentioned as a sort of a mutual clause. So do you think that's a fair reflection, or should that be an ambiguous term, or should that be like legally bounded in the shareholder agreement?
Let me understand your question. You're saying that if you have a company or you have a venture in which there are multiple shareholders and you get a new investor in terms of the exit opportunities for the existing investors, is it fair to have a minimum IRR or a minimum rate of return defined? I guess it depends really on the individual situation. I don't know whether my panelists have any other possibilities. It really is a function of the business itself. Whether
the question is more.
I think for angel investors, it's pretty silly to expect an IRR. I mean, you have an overall IRR for the portfolio of investments that you've made, but I think putting individual IRRs in a term sheet is not done.
The question pertains mostly in cases where the entrepreneur mentions, around XYZ percentage negotiable with mutual consent. So is that a fair enough metric to put in a shareholders agreement? That's my question.
For your existing investors?
Yes.
So if you have 10 people who have co-promoted a business, is that what you're asking? I'm not clear about your question at all. Maybe we can talk to you offline. That would probably be better. Yes, this gentleman up front, I think he has the mic.
Yeah. I have a question. The first question is, how do you arrive at a valuation? What are the key parameters? Because for an entrepreneur, this is a question like, should it be 100 crores? Should it be 50 crores? Should it be 10 crores? The figures are jumping that much. So we would like to know please put some light on that.
I'm going to give you, okay,
Thank
Sagar, you go first, then I'll add on to it.
See, there's no thumb rule to valuation, okay? But generally, like in our case, I'll give you our example. So we got 5x of our turnovers, looking into what Domino's was also trading at. They were trading at 5.8 times of, if you look into their earnings per share. So, looking into that matrix, looking into other investments done in the F&B industry, so 4 times to 5 times of turnover, depending on at what pace you're growing at, was the, you can say the thumb rule for our case, okay? Because when you're a new company, it's about top line and how soon you can grow. Profitability is not really looked into. I mean, you are profitable, that's a very good sign, but the investors, the angels are quite kind enough to, look into top lines, which is a very good thing, because if you start looking into only EBITDA earnings or, whatever, it's not going to be too much. So, looking into the normal market trends, what we did was, we gave a comparison of what Domino's was trading at mainland China, what they were trading as. And there were a lot of investments happening in the F&B space, so at what they were trading as and how good we are, or how more superior we are compared to them, we got a 5x. So that's how it happens. So you have to relate it to your industry and to the nature of your business. It will be very, very high for tech, I guess. Right? It will be really, really very high for tech, because tech might be 20 times, 30 times, or it might just be depending on the idea. So I think there's no thumb rule to it.
Yeah, I think this topic has actually been covered a lot. Yesterday also at the IN session in the afternoon, there was this question on valuation. The main session, somebody talked about Vinod Khosla's view on valuation. So, again, I'll just repeat what people have been saying throughout, which is it's more an art than a science, especially for the seed stage, because you don't have enough of data to project out. You haven't got a past track record, so you don't do things like discounted cash flows, etc. So you have, ultimately valuation is what you are willing to sell at and somebody is willing to buy your business at. That's ultimately the valuation, right? So if you find a buyer at your price and the buyer is willing to buy at that price, that becomes your valuation. Now, how do you arrive at that? There's, obviously how many other people are interested in buying, who else similar to your profile sold at what price. There might be some comparables. What is the market size? What business are you in? So those are all they help inform it. But ultimately, again, repeating myself, it's more an art at an early stage than science, and lots of people have repeated that.
Well, I've done valuations for 25 years, and I can assure you that it doesn't become much more of a science even for the largest companies. Who's to say why WhatsApp got the valuation it got? I've never been able to answer that. So actually speaking, all you can do is to get direction, is to have some directional sense, if you can use that term, based on the industry is saying, based on the multiples, whether it's the sales multiple, the EBITDA multiple, the PE multiple, or on how strong credentials you have as an individual promoter. If you've been there, done that, and you've set up 3 companies and sold them off, then possibly your valuation will be far higher. So actually there are a lot of subjective and quantitative factors which go into a valuation. At the seed stage, it's the hardest. It's really what you're able to negotiate for yourself. Having said that, I think it's important that you can't compare yourself at the seed stage. You're lucky, I must say. It's really kudos to you for that you could compare yourself to a well-established business and get a valuation which was, based on a multiple which somebody like Domino's, for example, was getting. It is unusual because it will normally be discounted for the risk of an early business, the stage of the business, where you've got to, how much you've invested, what your profitability is versus the other company's profitability, for example. So it remains a completely non-precise science and an art to negotiate. That I say this whenever I talk about valuations.
Just one more thing. An alternative to deciding on the valuation is often use a convertible note. We didn't talk about it out here. We assumed that the instrument is preferred shares, which get converted to common shares during a liquidity event. But another option that's sometimes used particularly in the Valley, is to create a convertible note. And what a convertible note will do is basically say that at the next round of valuation, my investment will convert perhaps at a discount to that. So for example, I might put in 2 crores in Sahil's business, in Sagar's business, in Sagar's business, and say I don't know what the valuation is right now, but we will decide when the next investor comes in, and we will use that valuation for the next round, maybe a Series A round, and I will get a discount to that. So if Sagar's valuation is 20 crores in the next round, I might get a 10% discount, so the price becomes 18 crores for me, and my 2 crores is now 2 crores divided by 18 crores. That's my ownership. And there might be a cap as well. So that's another way you might deal with kind of postponing valuation. Convertibles are not really in favor. I don't think anybody does that in India, but that's an alternative to postponing kind of the valuation discussion.
And that really works because that works in the instance because the early investor is taking a higher risk. When the business is less established, the early investor or the seed investor is taking a call. So therefore, they will get to lower valuation than the next round, for example. Yes, sorry.
So I am a founder and just wanted to understand that how much of control of the company goes out at 26%, 51% to investors and 76% one. And are there ways to handle it through convertible and other means where the equity is not with the investors? So if you can throw some light on that.
So actually these are 2 different questions, but there is a list of special resolution rights which relates to dilution of the investor, which relates to sale of business or asset, for example. It relates to perhaps remuneration, for example, he mentioned. This is defined by the Companies Act. There are special resolution rights. If I remember, there are some 10, 12 of them, which goes with a 26% control. So to below 26%, technically, as per company law, it's not applicable. It's a matter of negotiation. Above 26%, that's the minimum that they have to necessarily vote in the affirmative on. At 51%, so the next level of parting of control in terms of company law, again, negotiate you can by contract, anything, is at 51% where you actually have given up majority control of your business. So you've become a minority partner. Beyond that is 74%, when the 26% is are all the rights you'll have left, which we started out with. So as per the Indian Companies Act, 26%, 51%, 74%. These are the three telling points which transfer a significant level of control to the other party. I think the more detailed discussion we can have separately on that.
So just one more thing I wanted to add.
So yeah, the convertible. Okay.
I don't think it's a convertible. I think, like I said,
It's got to do.
if as a seed investor, standard terms, I will put in certain protections. Period. Irrespective of my shareholding, whether I own 15% or 7%, if you take my term sheet, you're going to give me certain protections. As I said, those include and certain veto rights. So you cannot raise capital without getting my consent. You can't change the class of preferred shares and issue new types of preferred classes that are superior to mine without my permission. You can't go and raise debt without my permission. Okay, so those are protections more than control. Okay, the other thing that sometimes founders might need to worry about is what happens if they get fired. Those typically happen in later rounds. You know, the angels are not, the angels, say at the end of the day, angels aren't going to run your company. So they are looking for protection, not control. Okay, so most of the things that you should be negotiating on are the protective provisions as opposed to the control provisions. Okay, because the angels cannot run your company. They cannot control, and they don't want to. I mean, most angels have day jobs. Most angels have 15 other companies that they're invested in. So they're just there to, they basically want to protect themselves. There are, you know, when you go into maybe series A, B, C, you've got to worry about what happens if you get fired. If you're not performing, you get fired. And you have things like single trigger, double trigger. Again, we don't have time to explain those, but these are provisions under which founders can protect themselves. Because often founders are, one thing we forgot to talk about is founders will vest. So for example, even though you, Sagar may have owned, you know, 80% of the company when I took 2 crores for his 10, he will start vesting again. Okay, so that's again something you negotiate. And if he gets fired, he has to protect himself by ensuring that if he gets fired, he either gets his entire vesting, or, you know, there's those are the kinds of things you've got to worry about more than control.
More questions? We should go at the back, I think. Yes.
So I have got 2 questions. One, I will start from the convertibles one. It's a generic question. Why don't we see too much of convertibles happening at the seed stage through our Indian angels as compared to that happens in Silicon Valley? The second is, what should be an ideal mix of the participation, the liquidation preference and the conversion for the participation, so that we set a right precedent for the next round in the seed round?
So I think in terms of, it's a moot point why Indian angels are not so keen on convertibles. Perhaps it's a maturing of the ecosystem to my mind, and it's lack of full appreciation of what a convertible can do, both for the entrepreneur as well as for the investee. Straight equities or pref equities, something which is far better understood in my mind. That's the only thing which comes to my mind when I look at the lack of interest in convertible options here in India.
On your second, maybe I'll take your second question on kind of what's good practice for liquidation and participation. So it's typically 1x and either full participation or participation with cap. I think, Sagar, you had negotiated, maybe you can talk about how you negotiated the liquidation preference.
We done a 1x, like you said, rightly said. And again, that entire terminology was explained to me in the correct manner. And I think it made sense because, you know, the investor is putting in something, so he needs to get that thing back. He's taking that risk. And uske upar mein whatever he gets, which you rightly explained. Yeah, 1x.
And you had a cap as well, right? You had a participation
Yeah,
cap.
I think it was 15% if I'm not, if 15% I guess, I'm not too sure.
It has to be, it's probably like a multiple of x. So typically
No,
3x
1x was our, this thing, minimum. No, I don't think we had a cap. I have to check. I'm not too sure.
Okay.
Yeah.
So it could be either full participation or participation with cap. If there are caps, it might be something like a 3x cap. So that's typically a fair benchmark.
More questions? I think you need a mic.
A little louder on this one. I just want to know, like, Suppose there is an investor that made some investment. After that, how does a founder make some more investment into the company by adding in more money? Or at what stage, if we want to liquidate the funds or some of the shares, is it possible, or what are the processes for that? Thank you.
See, like I said, I mean, there are certain shares that are left free and certain shares which are like locked. So you have that many shares, you can sell that to the secondary market, you can sell it to any other investor, you can pull in your own money, but whatever new money you put in, the entire SHA would change. I mean, the entire cap structure would change, to be honest. So even if you're putting in more money, your cap structure will change. So you have to keep the investors updated, and I think any small amount of money will also change the entire cap structure. So there is this, that's why this cap is given. Today, the reason that they lock your shares is, supposing they give an entrepreneur the entire money and what if he just stops doing the business and just goes away with it. So that's why they lock your shares so that, you cannot sell the entire thing and go away or do anything with it. So I think all these terms that we have in the term sheet, if you give it a deep thinking, it has a logical reasoning to it. And I think the investors also have learned this over a period of time, like how the entrepreneurs have also learned. It's all about trial error, and I think it's come to a process, it's come to a stage. I mean, that's how I guess things have come, and things have become so well defined.
There's one gentleman there, last question, though the organizers are telling me our time is up, so very quickly. Series A, Series B, Series C. Series A is the first professional round of investment you get. Well, okay, C. Yeah. So it's an institutional investor, and thereafter whatever investor series you get, basically. So it's the series of investor, the rounds of investment.
Yeah, and in some ways, they may be defined even by size, right? So your angel round might be anywhere from 25 lakhs, could go up to several crores. Your Series A might be anywhere from 10 crores to 20, 30 crores. Sagar was a rare. His first round was pretty much like a Series A round, right? He raised 10 crores. So that was actually more like a Series A. And then Series B are subsequent. And what you see now, I think with many of our e-commerce companies, they've gone into Series E and F. And the amounts just get larger and the valuations get larger as well.
Okay, may I take the occasion also to thank both of you, Ajay, Sagar, thank you so much. And all of you, thank you very much. I hope this was useful. And I'm sure that there are many more questions in your mind. So my wish and hope for all of you is that you do get a specific term sheet which you then have to demystify. So all the best to all of you, and thank you.